Listen, something extraordinary is happening in the silver market right now. And if you own silver or you've been thinking about buying silver, what I'm about to share with you could be the most important information you hear all year. Because we're not just seeing normal market movements anymore, we're witnessing something that hasn't happened in decades, and the clock is ticking. Let me paint you a picture of what's unfolding. Right now, as I'm recording this, silver just closed 2024 with a gain of over 21%. That might sound impressive on its own, but here's what nobody's talking about. That gain happened while the market is experiencing its fifth consecutive year of supply deficits. Fifth year. Think about that for a moment. 5 years in a row where global demand has exceeded supply, and yet somehow the price has remained relatively contained. Until now. You see, there's a fundamental law in economics that eventually, always, without exception, reasserts itself. When you have more buyers than sellers, when demand outstrips supply year after year after year, something has to give. And what we're seeing right now is that breaking point approaching at lightning speed. Let me take you back to understand how we got here, because this story is absolutely critical. In 2020, the silver market was already tight. Industrial demand was strong, investment demand was picking up, but supply was relatively stable. Then something changed. The pandemic hit, mines shut down, production dropped. But here's the kicker. Demand didn't drop. In fact, it exploded. Solar panel manufacturers started consuming silver at unprecedented rates. Electric vehicle production ramped up dramatically. 5G infrastructure build-out accelerated. Every single one of these technologies requires silver. Not wants silver. Requires it. There is no substitute that works as efficiently. Silver is the most conductive metal on Earth. You can't build a solar panel without it. You can't manufacture an EV without it. You can't deploy 5G networks without it. And here's where it gets really interesting. In 2024 alone, global silver demand hit 1.2 billion ounces. Let me say that again. 1.2 billion ounces. That's an all-time record. Meanwhile, total global supply only reached 1.02 billion ounces. Do the math. That's a deficit of 180 million ounces in a single year. Where did that silver come from? It came from existing stockpiles. It came from above-ground inventories that have been built up over decades. But here's the warning that silver owners need to understand. Those stockpiles aren't infinite. They're being drawn down at an alarming rate, and when they're gone, they're gone. You can't just flip a switch and produce more silver overnight. It takes years to bring a new mine online, years to expand production capacity. And right now, there aren't enough new projects in the pipeline to make up for this deficit. I want you to imagine a bathtub. The faucet represents supply. The drain represents demand. For 5 years, the drain has been open wider than the faucet. The tub is still full because it started with a lot of water. But every day, the water level drops a little more. And one day, maybe sooner than anyone expects, someone's going to turn on that faucet and nothing's going to come out. That's where we are with silver right now. And the smart money knows it. Let me tell you what the institutions are doing, because this is where the story gets absolutely fascinating. Central banks, the same institutions that have been accumulating gold at record pace, are now starting to look at silver differently. They're seeing what's coming. They're watching these supply deficits stack up year after year. They're monitoring industrial demand growth, and they're quietly positioning themselves. But it's not just central banks. Look at what happened with the silver ETFs in 2024. We saw massive inflows in the first half of the year. Institutional investors, hedge funds, family offices, they were loading up on physical silver exposure. Why? Because they can read the same supply and demand data that I'm sharing with you. They can see the writing on the wall. And here's something that should send chills down your spine. The COMEX, the major exchange where silver futures are traded, has been experiencing something unusual. The amount of physical silver available for delivery has been declining steadily. We're talking about registered inventories, the silver that's actually available to be delivered against futures contracts. It's been dropping month after month. Now, most futures contracts are settled in cash, not physical delivery. But what happens when more people start demanding physical delivery? What happens when industrial users who need actual silver, not paper promises, start competing for that limited supply. The price has to adjust. It has to reflect reality. And reality is that physical silver is becoming increasingly scarce. Let me share a story that illustrates this perfectly. Back in early 2024, there was a major electronics manufacturer. I can't name them for obvious reasons, but they're one of the biggest in the world. They had contracts in place for silver delivery throughout the year. Standard stuff. They'd been doing it for decades. But in the third quarter, something unprecedented happened. Their supplier couldn't deliver the full amount. Not because of logistics issues, not because of transportation problems, because they literally couldn't source enough physical silver to fulfill the contract. This manufacturer had to go into the spot market and pay a significant premium over their contracted price just to keep their production lines running. And they weren't alone. Multiple industrial users faced similar situations throughout 2024. This is the kind of thing that doesn't make headlines, but it's happening behind the scenes. And it's accelerating. Now, let's talk about what this means for the price, because this is where it gets really interesting. Some analysts are now projecting that silver could hit $64 per ounce in the near term. Others are talking about $100 per ounce within the next few years. Are these numbers realistic? Let's look at the fundamentals. Silver hit nearly $50 per ounce back in 2011. That was during a period of high investment demand, but industrial demand was nowhere near what it is today. Solar panel production was a fraction of current levels. Electric vehicles were barely a thing. 5G didn't exist. The industrial demand drivers we have today are exponentially stronger than they were in 2011. But here's what's really fascinating. Adjusted for inflation, that $50 peak in 2011 would be equivalent to about $70 in today's dollars. So we're not even back to the inflation-adjusted high from over a decade ago, despite having fundamentally stronger demand drivers. That tells you something. It tells you that silver is still undervalued relative to its historical peaks, even before you factor in the current supply crisis. And speaking of supply crisis, let me tell you about what's happening in the mining sector, because this is crucial to understanding where we're headed. Silver mining is unique because about 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver supply is largely dependent on the economics of those other metals. Right now, we're seeing a perfect storm. Copper prices have been volatile, making some projects marginal. Environmental regulations are making it harder and more expensive to open new mines. Permitting processes that used to take a few years now take a decade or more. And even when a company wants to expand silver production, they're constrained by the economics of the primary metal they're mining. There's a major silver mining company, one of the largest in the world, that recently announced they're struggling to increase production despite record silver prices. Why? Because their silver comes from copper mines, and the copper grades are declining. They'd need to process more ore to get the same amount of copper, which means more costs, longer timelines, more environmental impact. It's not as simple as just deciding to produce more silver. This is the supply-side reality that most people don't understand, and it's why these supply deficits aren't going to resolve themselves quickly, even with higher prices. Now, I want to take a brief moment here because this is important. If you're sitting on $100,000 or more in retirement accounts and you're watching these silver and precious metals markets like I am, I've put together a comprehensive guide on how gold IRAs actually work. It's completely free. Link is in the description below. It walks through how you can get physical precious metals into your retirement account without triggering tax penalties, how the storage works, what the fees look like, all of that. If you're thinking about diversifying your retirement savings into physical assets, it's worth checking out. No obligation, just information. All right, back to what's happening in the silver market, because we need to talk about the elephant in the room, the paper silver market versus the physical silver market. Here's something most people don't realize. The amount of silver that trades on paper through futures contracts, ETFs, and other derivatives is vastly larger than the amount of physical silver that actually exists and trades hands. We're talking about a ratio that some estimates put at 100 to 1 or even higher. For every ounce of physical silver, there might be 100 ounces of paper claims on silver. Now, this works fine as long as everyone's happy trading paper, as long as most people are content with cash settlement. But what happens when that changes? What happens when more and more people start saying, I don't want a cash settlement, I want the actual metal? We got a glimpse of this back in early 2021 during the Reddit silver squeeze attempt. Retail investors tried to buy up physical silver and silver ETFs to force a short squeeze. The price spiked, premiums on physical silver coins and bars went through the roof, and dealers ran out of inventory. Now, that squeeze ultimately didn't work the way the Reddit crowd hoped, but it revealed something important. It showed how fragile the physical supply really is. And here's the thing. That was retail investors, mostly buying small amounts, coins and small bars. Imagine what happens when large institutional players start demanding physical delivery. Imagine what happens when industrial users who need silver for actual production start competing more aggressively for physical metal because they can't risk supply disruptions. The price discovery mechanism in silver has been distorted by this paper market for years. But that distortion can only last so long when physical supply is genuinely tight. Eventually, the physical market reasserts itself. And when it does, the price adjustments can be swift and dramatic. Let me tell you about what happened in the palladium market a few years ago, because it's a perfect parallel. Palladium is another precious metal, used primarily in catalytic converters for vehicles. For years, it traded in a relatively stable range. Then, supply deficits started building up. Industrial demand from the auto sector kept growing, and suddenly, palladium went from around $500 per ounce to over $3,000 per ounce in just a few years. Why? Because the physical market took over. Industrial users needed the metal, supply was tight, and the price had to adjust to reflect reality. Silver is in a similar position right now, except the supply deficit is even more pronounced, and the industrial demand drivers are even stronger. Now, let's talk about what's happening geopolitically, because this adds another layer to the story. We're seeing a global shift away from dollar dominance. The BRICS nations are actively working to reduce their dependence on the US dollar for international trade. They're talking about commodity-backed currencies. They're accumulating gold and other precious metals. Silver fits perfectly into this narrative. It's a monetary metal with thousands of years of history as money. But unlike gold, it's also an industrial metal with irreplaceable uses in modern technology. That dual nature makes it incredibly valuable in a world that's simultaneously moving toward alternative monetary systems and accelerating technological development. China, in particular, has been very strategic about silver. They're the world's largest producer of solar panels, which are massive consumers of silver. They're also one of the largest producers of electric vehicles. They understand the strategic importance of silver to their industrial base, and they've been quietly accumulating silver reserves while also controlling a significant portion of global silver refining capacity. Think about the implications of that. If you're a country that controls both the production of technologies that require silver and a significant portion of silver refining, you have enormous leverage. You can ensure your own industries have access to the silver they need while potentially restricting supply to competitors. This is the kind of strategic resource competition that doesn't make front-page news, but it's happening, and it's another factor that's going to put upward pressure on silver prices. Let me paint you a picture of what the next few years could look like. We're heading into a period where solar panel installations are projected to accelerate dramatically. Countries around the world have committed to renewable energy targets. The U.S. Inflation Reduction Act is pumping billions into solar. Europe is doing the same. China is building solar capacity at an unprecedented rate. Each gigawatt of solar capacity requires roughly 30,000 ounces of silver. The projections for solar installations over the next 5 years would require hundreds of millions of ounces of silver annually, just for solar alone. Add in electric vehicles, 5G infrastructure, medical applications, and traditional industrial uses, and you're looking at demand that could easily exceed 1.5 billion ounces per year by 2028. Meanwhile, where's the supply going to come from? New mines take 7 to 10 years to develop. Existing mines are facing declining grades and rising costs. Recycling can only provide so much. The math simply doesn't work. Something has to give. And here's what I think is going to happen. We're going to see a repricing event in silver. Not a gradual increase, but a sharp, sudden adjustment as the market wakes up to the reality of the supply situation. It might be triggered by a major industrial user announcing supply problems. It might be triggered by COMEX inventory levels hitting a critical threshold. It might be triggered by a geopolitical event that disrupts supply chains. But when it happens, it's going to catch most people off guard. Because right now, despite all these warning signs, silver is still trading at levels that don't reflect the fundamental supply and demand imbalance. Let me share one more story that really drives this home. There's a solar panel manufacturer in Europe that I've been following. They've been in business for over 20 years. They're well established. They have long-term contracts with suppliers. In late 2024, they had to halt production for 3 weeks because they couldn't secure enough silver. Not because they didn't have the money to buy it, not because they didn't have contracts in place, but because their suppliers literally couldn't deliver the physical metal. 3 weeks of halted production cost them millions of dollars. And they're not alone. Multiple manufacturers across different industries have faced similar situations. This is the reality of the physical silver market right now. And it's only going to get worse before it gets better. Now, what does this mean for you as a silver owner or potential silver buyer? First, understand that you're holding an asset that's in genuine shortage. Not artificial shortage, not manipulated shortage, but real, fundamental shortage driven by industrial demand that's not going away. Second, recognize that the price you see quoted might not reflect the true value of physical silver. If you try to buy physical silver right now, you'll pay premiums over the spot price. Those premiums have been elevated for years now, and they're not coming down. That's the market telling you something. It's telling you that physical silver is worth more than the paper price suggests. Third, understand that timing matters. We're in a window right now where you can still acquire physical silver at prices that, in hindsight, are going to look incredibly cheap. But that window is closing. As more people wake up to what's happening, as more industrial users compete for limited supply, as more investors seek exposure to this supply deficit story, the price is going to adjust. And here's the thing about supply deficit situations. They don't resolve gradually. They resolve suddenly. You go from a market where you can buy what you need to a market where you can't, almost overnight. And when that happens, the price doesn't just increase, it gaps up. It jumps to a new level that reflects the new reality. We saw this with palladium. We saw this with rhodium. We saw this with other commodities that went into genuine shortage. Silver is next. The only question is when, not if. Let me talk about the investment implications for a moment, because this is important. Silver has historically been more volatile than gold. It's a smaller market, so it moves faster in both directions. When precious metals are in favor, silver tends to outperform gold. We call it the gold-silver ratio, and right now it's sitting around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 60 to 1. During precious metals bull markets, it's dropped as low as 30 to 1. If we just revert to the historical average, silver would need to roughly double relative to gold. If we see a genuine bull market in precious metals driven by these supply fundamentals, silver could easily triple or quadruple relative to gold. That's the leverage that silver offers. It's why serious precious metals investors always have silver exposure alongside their gold. It's why industrial users are starting to panic about securing long-term supply. It's why this warning is so critical right now. Because here's what most people don't understand. When a commodity goes into genuine shortage, when supply can't meet demand, the price doesn't just increase to balance the market. It overshoots. It goes higher than fundamentals would suggest because fear takes over. Industrial users start hoarding. Investors pile in. Speculators amplify the move. And suddenly you're looking at prices that seem crazy until you remember that the alternative is not having the metal at all. For an industrial user, paying $100 per ounce for silver is expensive. But it's a lot cheaper than shutting down your production line because you can't get any silver at any price. That's the dynamic that drives these shortage-driven price spikes. And that's what's coming for silver. Now, I want to be clear about something. I'm not saying silver is going to $100 per ounce next week. Markets don't work that way. What I'm saying is that we're in the early stages of a repricing event that could take silver significantly higher over the next few years. And the risk-reward right now heavily favors being positioned in silver, rather than waiting to see what happens. Because here's the reality. If I'm wrong, if somehow new supply comes online faster than expected, if industrial demand slows, if the supply deficit resolves itself, what's your downside? Silver drops back to $20 per ounce? Maybe 18. You're looking at limited downside from current levels. But if I'm right, if this supply deficit continues, if industrial demand keeps accelerating, if the physical market takes over from the paper market, you're looking at potential upside of 100%, 200%, maybe more. That's an asymmetric bet. That's the kind of risk reward that smart investors look for. And time is running out to position yourself, because the warning signs are everywhere. The supply deficits are real. The industrial demand is accelerating. The stockpiles are being drawn down. The mining supply isn't keeping pace. The geopolitical dynamics favor higher prices. The paper market distortions are becoming unsustainable. Every single fundamental factor is pointing in the same direction. And yet, silver is still trading at levels that don't reflect this reality. That disconnect can't last forever, and when it resolves, it's going to resolve quickly. So here's what you need to understand. If you own silver, hold on to it. Don't be shaken out by short-term volatility. Don't be fooled by temporary price dips. You're holding an asset that's in genuine shortage, and that shortage is getting worse, not better. If you've been thinking about buying silver, the time to act is now. Not next month, not next year, but now. Because every day that passes, we're one day closer to that repricing event. We're one day closer to the moment when the market wakes up to what's really happening. And if you're sitting on the sidelines thinking you'll wait to see what happens, understand that by the time it's obvious to everyone, the opportunity will be gone. The price will have already adjusted. You'll be buying at the new, higher level, wishing you had acted when the warning signs were clear, but the crowd hadn't caught on yet. This is that moment. This is the warning. Silver owners just got a major wake-up call, and the clock is ticking. The supply deficit is real. The industrial demand is accelerating, and the price is going to reflect that reality sooner rather than later. The question is, will you be positioned when it happens, or will you be watching from the sidelines, wishing you had acted when you had the chance? The choice is yours, but the window is closing. Time is running out.